Mr. Speaker, I rise in support of this bipartisan resolution of disapproval. This resolution is an essential effort to protect consumers and foster innovation in digital assets markets. It's also critical to stop the Securities and Exchange Commission's regulatory power grabs and efforts to circumvent the Administrative Procedures Act. I want to thank my friend, Congressman Flood of Nebraska, a leader on financial innovation and digital asset policy, for introducing this bipartisan resolution. Staff Accounting Bulletin, or SAB 121, is one of the most glaring examples of the current Securities and Exchange Commission's reign of overreach. Through SAB 121, the Commission is trying to dictate how financial institutions and firms safeguard America's assets, in particular here, digital assets, under the guise of so-called staff guidance. Let me explain why this is deeply concerning. Because they call it a staff guidance, the Securities and Exchange Commission could avoid public comment and the rulemaking process governed by the Administrative Procedures Act, or APA. Now, this is whereby the public gets to give an opinion back or expertise back to the agency so they can improve the rulemaking by listening to the public. This is a long-standing process here in the United States. And not only did the Securities and Exchange Commission bypass Congress and the Comptroller General, but the Commission did not even consult with other financial regulators, prudential regulators responsible for overseeing banks prior to issuing SAB 121. Thanks to the work of the House Financial Services Committee and my friend, Senator Lummis, the GAO rightly deemed SAB 121 a rule for purposes of the Congressional Review Act, providing Congress with the opportunity to right the wrong of agency action. SAB 121 requires financial institutions and firms that are safeguarding their customers' digital assets to hold those assets on their balance sheet. That means banks would be required to take on significant capital, liquidity, and other costs under the existing prudential regulatory framework. This essentially makes it cost prohibitive for financial institutions to custody their customers' digital assets. Now, this is a massive deviation for how highly regulated banks are traditionally required to treat assets they hold on behalf of their customers. Now, this is the point that everyone can understand. This is a change that harms consumers and makes them less protected. It's not a change for the better, clearly. It limits the options for consumers and increases concentration risk to the financial system. And perhaps even worse, it could leave America's assets vulnerable in the event of a bank failure, just as we saw with Silicon Valley Bank last year. If you want Americans' assets to be protected, they should be held in custody, not on a bank balance sheet. And if you want Americans to be able to engage with digital assets safely and securely, banks, which are some of the most highly regulated entities in our country and in the world, are probably the best places for them to be kept. Unfortunately, SAB 121 makes this nearly impossible. We hear a lot from our Democrat colleagues about consumer protection. If that concern is genuine, and I think it is, they should support Congressman Flood's bipartisan resolution that's before us today. Let me give you one example of why this guidance is problematic. The Securities and Exchange Commission recently approved 11 Bitcoin ETFs, which allow everyday investors to gain exposure to this new technology. It's a decade old, but it's relatively new. Of those 11, 0, and I repeat, 0, use banks as their primary custodian. Instead, all that risk is now concentrated in a few entities. So let's do a quick recap. The Securities and Exchange Commission, through Staff Accounting Bulletin 121, upended traditional custody practices. So just like you hold a stock with a stockbroker, it's held in custody. That means that that entity, if it goes bankrupt, your asset is still protected. It is held in custody and safeguarded as if it's in a safe. And so we want digital assets to be treated the same way that we treat other digital assets and protected. So this staff accounting bulletin upends traditional custody practices for banking institutions, and it made a joke of the rulemaking process and ignored other regulatory agencies and market participants that are impacted by this bulletin. That's a bad process and even worse policy outcomes. So if you want consumers to be protected in digital assets markets, vote yes on this resolution. If you want to return bank custody practices to the tried, tested, and successful approach that we've had in this country for centuries, then vote yes. If you support financial innovation, you should vote yes as well. And finally, if you want to send a message that rogue regulators cannot circumvent Congress and our well-established rulemaking process, vote yes. So let's bring this common sense, this level of common sense into the world of the digital asset debate or crypto, and bring consumer protection back to this marketplace where it needs to be. And with that, I encourage my colleagues to vote yes on this Congressional Review Act. But finally, I want to thank Congressman Flood on the Republican side and Congressman Nickel on the Democratic side for their leadership on this important topic. And with that, Mr. Speaker, I reserve the balance of my time.